What's up, my fellow wealth creators? Matty Ice here. Welcome to another episode of the Millennial Wealth Creator podcast. I have my good friend, been a long time, man, Michael the G Garcia from IC Life. What's up, man? How you doing? I miss you, bro.
I'm doing great, man. It's been way too long since we last got together and shot a video. And
it has, dude. It has. We need to get back on the bandwagon. And you know what's crazy is there's always plenty to talk about, as we're going to see in this episode. You know, there's just never a shortage of very interesting material, like content material to discuss. And today we're going to really debunk some of the myths, some of the more common myths about cash value life insurance, or according to the buy term and invest the rest crowd, trash value life insurance, right? And it's just always funny to me when I hear that term, and some of the myths that they do propagate. It's very bizarre. And like, here's the thing, is I don't have a problem with people disagreeing on like what they think is maybe the best way to build wealth, for example. All right, so obviously cash value life insurance is like the arch enemy of buy term and invest the difference, right? So it's natural like that they're going to push back on that. But if you're going to do that, have some legitimate reasons for it. Okay, like calling it trash value life insurance and like some of the thing. This is why we're calling them myths, because some of the things they say about it it's just not true. And they say it in order to promote their own narrative, so you buy their products. And I just don't think that's a good way at all to promote any product at all. Like, your product should win on its merits, on its benefits, right? Let people make their own decisions based on what their goals are, what their current financial situation is. Maybe right now, buy term and invest the difference is better for you. Maybe you're not able to put enough money into a whole life policy, which is one form of cash value life insurance. At the moment, there's nothing necessarily wrong with that, right? But you need to make sure that you have all the information about these different products, assets, strategies, etc., so that you're making an informed decision about what is best for you. All right, and that's why Michael and I, we're going to debunk some of these myths, because he had an interesting conversation, which I always see you having these very interesting conversations and, dare I say, debates inside like these life insurance agent Facebook groups and stuff like that. So why don't we do this, Michael? Why don't we kick it off with giving us a little bit of context about how this topic came up and what that conversation, like, what was the debate, right? How did it all get started?
Yeah. So, I mean, you said there's always content, because unfortunately this industry is full of garbage out there, right? Full of, I just call them lies, right? Full of myths.
Sometimes they are.
Whatever you want to call it, right? And again, it's people who push a certain narrative, and I think you hit it right on the money. There was one guy, and he had made a comment that this is the only way. It's this way or the highway, and it's like,
right. That's dangerous.
You understand how ignorant you sound? Not every client has the same goals, right? Not every client has the same objective. And when you talk, I think we're going to talk a little bit about this, but you talk about the need of life insurance. The reality is the person buying the life insurance on themselves, they don't need life insurance. Life insurance is not a need-based product, right? Your loved ones are going to appreciate you for it. But the reality is those people that, and you come across this every now and then, where you have a person who doesn't want to buy, they're just like, what do I care? I'm going to be gone anyway.
Right.
Well, honestly, that's the truth, right? This is something that you do out of love for people that you care about.
Sure.
Like for me, it's for my daughter. And so when you start to take those things into account, you start to figure out, okay, well, what do I want to cover? What are my objectives here? Do I want a permanent death benefit to make sure I cover legacy and estate planning, taxes? Or do I just need something large and cheap because I haven't made my money yet, or my house isn't paid off yet, and I won't need it after I pay my house off? So that's where, hey, sometimes a term is going to make a whole lot of sense, but sometimes a whole life is going to make a lot more sense. And sometimes Guess what? My clients get both. Again, different needs, different objectives.
Imagine that. It doesn't have to be one or the other. You can actually do both if you wanted to. Holy smokes, who would have thought?
Yeah, 100%. So, anyways, yeah, I think I ended up making a post, and you saw that, Matt, and I saw you liked it, and it basically came from somebody calling whole life insurance trash value life insurance. And I was like, you're an idiot.
Why do you? Let me ask you this. Let's start with this. Why do you think they call it that? Do you think it's like just because they're so committed to pitching their own narrative? Like, do you think maybe they've done they've actually done research and it really doesn't make sense, or are they just repeating, whatever's been passed down to them from their upline, and they're just convinced by their upline that, or maybe other gurus like, oh yeah, all cash value life insurance sucks. Like, do you think they've even done their research into it, or is it just to promote their own narrative?
Honestly, Matt, you ever seen that that Family Guy episode where the Kool-Aid man bursts through the wall?
Yeah.
He's like, oh yeah.
Yeah.
Well, I think they've drunk so much Kool-Aid that they've actually hallucinated that vision. Right. The reality is, no. I'm gonna put a bold statement out there. 97% of life insurance agents don't even know what they're selling. They don't understand the product.
Right.
They're repeating. Yeah, it's just lack of education. They're repeating whatever story or narrative the organization that recruited them is teaching, right? And this isn't, again, it's not to rip on term, because I sell term all the time. It's great. But we're talking about people that create these narratives to sell term, and everything else is like the devil, right? And there's companies on the other side too. Like, there are companies out there that, oh, IUL is the greatest thing since sliced bread. And it's like, term is the devil. Like, no, term is not the devil either, right? It's like, again, specific products for specific uses. It's like your toolbox has a hammer, a screwdriver, right? Has some different tools in there. You don't use the same tool for every purpose. Right.
Now, see, here's the thing, is I'm in the camp of high cash value, dividend paying whole life insurance, implementing things like infinite banking, because that makes sense for me. That works really good for me. I understand it. It's been a game changer in my life. That doesn't mean I think buy term and invest the difference is the devil. We've had plenty of conversations about index universal life insurance. If it was great as every agent says it is, then every policyholder, every client would be doing very well. But that's not the case, because a lot of them are trash. And to play devil's advocate a little bit here, to be fair, like the point I'm getting at is that these are just tools, okay? So it makes sense for some, doesn't make sense for others. That's totally fine. Doesn't mean the other one is bad. With that said, there's also very specific ways of doing things. So in my mind, like when I hear trash value life insurance, I've actually seen trash whole life policies because they weren't set up right. So to play a little bit of devil's advocate on myself, kind of, is maybe some of the policies they've seen, like with whole life insurance, it was not set up right. And the client is not getting all of the benefits that they could had it been done correctly by the agent. And if that's what they're talking about, that particular instance, it was probably not a good product for them, or at least it wasn't set up right. Same thing with IUL, right? Most of the IULs we've seen are trash, but I've seen some good policies. I know some people that do it right. I know, actually, Michael, I think you set up you'll set up IULs for people if it's the right fit.
Yeah.
Usually that's maybe not what you do. All right, but that's the point here, guys, is like when you hear things like trash value life insurance, that should actually be a pretty big red flag, especially when they can't back it up with any non-biased information.
Yeah.
Right. Because like a lot of the times they'll show you just the bad side, not the potential good. Because my whole life policies are kicking ass, dude. Right. So I don't know what you're talking about. Trash value life insurance. Mine are freaking kicking ass.
And same thing the other way too, right? Like some of these companies for their policies only show you the good side, but they don't talk about the bad. IUL is a perfect example of that, right? And so This is the best way I can explain it. If you had a apple, I'm gonna use life insurance and retirement. The apple is your retirement account. An orange represents your life insurance. So me ripping on the fact that these agents are selling this orange as an apple doesn't mean I don't think the orange has any value or it's no good, right?
Sure.
I think the orange makes a perfectly good orange. I'm just saying it's not an apple. That's all I'm saying, right? Like I'm not ripping it for what it is. I'm just saying it's not an apple. And that's what people need to understand, because yeah, I think people get a little emotional and attached to whatever product they sell. I don't know why the emotion is so strong like that, but they think automatically, if you don't think it's the greatest thing since sliced bread and is a magic retirement pill and does this, and this, then you're ripping on the product. And it's like, no, I'm not ripping on the product. I'm just saying it doesn't perform the way you're explaining, right? And yeah, you're right, Matt. I do use IUL, right? And ultimately, IUL is simply a flexible term product with a cash value component. And if you really break it down, the whole buy term and invest the difference, that's the concept behind IUL.
Mm-hmm.
It really is. And so the fact that they rip the product that follows the concept that they are saying, it's like, what is going on here? Like, do you even understand how this
you clearly haven't thought this out very much.
So that's why I made the post, and the post, so you guys know, it's life insurance agents say the darndest things.
Yeah, that's a fun one. Let's get into some of these specific myths, some of the statements that people will make when they're trying to convince people that something like whole life or even IUL is trash value life insurance, right? This is one of my favorites. I want to start with this one because this is so ridiculous. Like, it's such a bizarre thing to say and to hear. Cash value life insurance is a scam because you lose the cash value when you die. Or as Dave Ramsey would say, that evil life insurance company, it steals your cash value. Okay? This is one of the most ridiculous things I hear about cash value life insurance, whole life insurance, whatever. So, Michael, why don't you go ahead and kick us off with that one? What are your thoughts on that? And then I'll share mine.
Yeah. So real quick, what type of policy we want to hit first? Do we want to hit whole life or do we want to hit IUL?
Let's do whole life, because a lot of times they're talking about whole life, and with this particular myth, at least that's what I've seen. So let's focus on whole life.
Yeah. Okay. Well, on a technicality, you do lose the cash value. You're like, when they pay you, it's not the cash value you're getting. But the key here is the client actually losing, right? Matt, can I share my screen? I'm gonna pull up a illustration so you guys can see exactly what I'm talking about.
Yeah, just hit that share at the bottom, and then I'll be able to bring it up.
Okay. Let's do the camera here. Yeah. Oh, no. I don't see a share. Present.
See present, the little plus sign.
Okay.
Yeah, on the little computer there. Computer icon.
Yep, I got it. Okay.
And then you should be able to choose entire screen. Okay, there it is. All right. There we go.
Okay, so you can see the illustration here?
Yeah, can you zoom in just a little bit so you can make the numbers a little bit bigger there? There we go. There we go.
So the point I want to make is this. Look, your death benefit, and I've seen Dave Ramsey talk about this too, right? So, your dividends or your money, it just buys more insurance. It goes into PUAs, right? And so if we look at the first year, we have $127,000 death benefit here, right? Now, if I were going to be on the losing side, I would continue to pay money in this, but I would have less money at the end, right? So in year 2, you can see my contract premium right here is $8,300. And if you look at my net cash value, we went from 5,900 to 13.2. So most of that money did go into the cash value, right? We just went up by about $8,000. But I want you to pay attention to this. How much did my death benefit go up? $20,000, right? So for me to say, no, I want my cash value, right? I want my initial death benefit plus my cash value because I don't want to lose my cash value. Well, that would be 127,000 plus 8,000. And what I have to say to that is, if you want the cash value and not the paid up addition value that adds on top of your policy, you're an idiot. Like, who would take the 8,000 over the 20,000?
Right.
Nobody. So they say that, which on a technicality, maybe it's true, right? But is the client losing because of that, or are they actually gaining because of that?
Right.
Because if you tell the whole story, the client's actually gaining, the family's gaining $20,000 in their benefit.
Yeah, far more than what you're putting into the policy.
Right. And that's the issue with that. That's the real issue with that, like, thought process that, the insurance company's making out here, they're winning, right? Like, no, actually the client's winning on that.
It's a massive win. So, all right, here's my thought on it. And I just think this is so easily debunked. It just comes down to a fundamental misunderstanding of what the cash value is. Now, on a technical basis, cash value just goes away. Your beneficiaries get the death benefit. The life insurance company is just going to write a check for whatever the death benefit is at the time you pass. Okay, but let me give an example here. This is the example I like to give when talking about this. Is, let's say you have a house worth $300,000 and you have $150,000 of equity, and which would obviously mean you have $150,000 on your mortgage. Okay, let's say you decide to sell the house tomorrow and you get $300,000 for that house. The buyer says, yes, I will pay $300,000. When you go to closing, do you really expect to get the $300,000 that the buyer paid and $150,000 of equity? Would you get both in that scenario? Okay, so obviously the answer is no. Does that mean the bank is stealing your equity? Or the title company? Is somebody stealing your equity? Yeah. Or if we just think about this logically, does it just make sense because I have a $150,000 mortgage to pay off and I'm going to get whatever's left over, right? So you don't expect to get both in that scenario. Why on earth would you expect to get both in a life insurance policy? It doesn't make any sense. The cash value is simply the equity in the life insurance contract. It represents how much you can borrow against the policy. That's pretty much it. And if you really, again, this is not technically what happens, but another way to think about it, to get over this stupid, ridiculous myth, is you could actually make an argument that your beneficiaries do get your cash value when you pass away. Think about this. I'll give you another example. Let's say you have $1 million death benefit and you have $500,000 of cash value. Okay. What happens when you pass in this example, okay, is the life insurance company is going to say, look, he has $500,000 of cash value. We're going to go ahead and give that to his beneficiaries. But since we're on the hook for $1 million death benefit, we're going to add an additional $500,000 on top of it to meet our death benefit obligation. Now, I want to be clear. It's not what the life insurance company does. They just write the check, okay? It's us who are overcomplicating this, all right? But that's another way to think about it. You could actually make the argument that they get the cash value and extra and more on top of it to meet the death benefit obligation. But the reason that it's so powerful as a death benefit is because it's passed on income tax-free. Like if you were to actually get the cash value and you have a gain, you could potentially be taxed on that. But because it's just being passed on in the form of a death benefit from a life insurance contract, that gets passed on income tax-free, completely avoids probate. So it's a good thing that the cash value just it's just the equity, guys. That's all it is. All right. So that's why this obsession about getting both has never made any sense to me. You got to come up with something better than that. Okay. Like
yeah,
that,
no,
it's just, when you just think about it for a minute, that doesn't make any sense.
yeah, I think your house example is a perfect example, because when you first buy that house on a 30-year mortgage, you didn't buy that house yet, right? You got to pay down the mortgage and build the equity. And same thing, I've heard it put this way. This is actually a pretty funny way, but I heard somebody say life insurance is the only way you can print money as a citizen, right? And so the idea is, by writing up a contract, you simply created an estate that you haven't earned yet, right? So you just created an estate.
Right. That makes sense.
But it's your obligation to eventually buy that estate, right? So that equity is a perfect example of, as I pay into my estate that I already got because I created it out of nothing, I'm building that equity within that estate. I'm paying it up.
Right. 100%. Yep. That's why it's so powerful, guys.
Yeah.
Not to mention all the other benefits that come with it. Yeah, go ahead.
And real quick on the IUL standpoint, the way they function is, again, they function as a term policy, and then it's the extra money on top of it. So it truly is a buy term and save the rest, we'll call it, right? Instead of invest the rest. But in that case, you do get the death benefit. The formula for the death benefit is the cash value plus the life insurance on every IUL.
Right.
So
yeah,
you get both. Mm-hmm.
Right. It's that myth has just never made any sense to me. So you hear somebody saying that, I just don't think they've really put the time and effort into understanding what they're talking about. So it should be kind of a red flag there.
Yeah.
We've got a couple of other myths here I think we should break down. I'm not sure which one I want to do next. I do want to cover this one. We could do this one. Nobody needs life insurance past 20 to 30 years. That's an interesting one. And that usually comes from people who believe in, or who promote like buy term and invest the difference. They think the idea is that your investments are going to do so good that you can be self-insured, which that's a whole other conversation in and of itself. That's so ridiculous. But this idea that nobody needs life insurance past 20, 30 years. Well, let's address the problem of that just being a very blanket statement and not understanding people, like not taking into consideration everybody's individual situation. Okay. So I'm not going to sit here and say that absolutely everybody needs life insurance. I think most people should have life insurance for their entire life. I don't see, like, there's just so many benefits to having it, especially when you set it up right. But I'm not going to sit here and say everybody needs to have life insurance or whole life insurance or whatever. So these types of blanket statements are just, they don't make any sense, because there's actually a lot of benefits to having life insurance beyond 20 to 30 years. Right. So what are your thoughts on that particular myth there?
Yeah. Well, honestly, I heard two myths in there. I heard two myths. So one of the myths that you just said was, my investments are going to do so well, I just be self-insured.
Right.
So
you don't need life insurance anymore.
I'm going to throw a challenge at you, Matt, because I think most agents would not get this answer. You might get this answer. But what is the definition of insurance?
The definition?
Yeah.
To indemnify against loss.
Yeah.
That's what initially comes to mind.
Right. It's transferring risk.
Transferring risk is a good one.
It's transferring risk from yourself to the insurance company. That's what insurance is. So when you understand that buying insurance is simply transferring risk off yourself to somebody else, then you understand there is no such thing as self-insured. By definition, self-insured is a myth.
Right.
That's the reality. Self-insured is a myth. But
the term itself contradicts itself.
Right. So
like, you're either transferring risk or you're not.
Yeah. And so let's
there's no in between.
Let's kill that myth right there. Right. And then the idea that you don't need life insurance. Well, the reality is nobody needs life insurance. Life insurance is a gift. It's something that you want to do to, again, transfer risk off your family, right? when it comes to life insurance, if you're buying insurance and you're the insured, you're not going to be around to see that benefit, the death benefit.
Right.
You're doing that because
it's really the family that needs it.
Right. You have somebody that you care about, you want to provide for, you want to leave money to, right? You want to make sure that hey, if I'm not here, they're taken care of. And so when you understand that, it's really a want-based product, not a need-based product. So that's a myth in itself too. The idea that, oh, you don't need life insurance anymore. Well, you never needed it in the first place, right?
You didn't, your family does.
It's because you want to do something, right? And so some people, I'll give you an example, Matt. I have a client that is retired, and they owe quite a chunk of money on their mortgage still, a couple, and they're in their 60s. And you know what? If something were to happen to one of them, they'd be in a world of hurt because that mortgage payment's still there and they would lose some of that income.
Right.
So how are you going to tell me that person, like I said, it's really for each other, right? But how are you going to tell me that the surviving spouse would be okay if they lost that income? Like, they still need protection.
Right.
And actually, somebody was saying, oh, at that age, it should always be permanent insurance. And so this is another example of when you are a good advisor, you actually take everything into consideration, understanding your client's situation. And the reality is, based on that client's budget, the permanent life insurance, the death benefit's not enough to even make a dent.
Right.
For the surviving spouse.
They're too old at that point.
Yeah. So what I did was I wrote a 10-year term for a larger amount, even though they're in their 60s. But what I understand is this: they're going to have a large enough chunk to create a lot of equity in that house or pay down some of it. And in 10 years, what's going to happen, right? Real estate naturally always goes up over longer periods. They're going to be paying down that mortgage. And if they need something beyond 10 years, that's something we can evaluate then. But the reality is, they're going to have different moves that they can make in 10 years, right? If they can get to that point, then the surviving spouse might be able to do, say, a reverse mortgage and eliminate the mortgage payment altogether. Right. So there's different moves that come in the future. So that's an argument that, hey, even vice versa, term makes sense for people even in their 60s and 70s sometimes. It's all a need, or not a need, but what's the goal, right? What is the desire? What are you trying to accomplish? So in that case, a term makes sense. And then in other cases, there's going to be, hey, I want to create an estate. I want to make sure when I pass, taxes are taken care of. Well, you can't do that on term. You can't guarantee that term is going to pay out.
It usually doesn't.
About 2% of them pay out, right? So if that's your goal, you want to make sure you have something that's going to be there when you pass. And the only way to do that is through a whole life product or something with a guarantee like a GUL, right?
To make sure that it's going to be there when you pass. You know, it's such a great example. And here's my frustration with that is if obviously we need to, as adults, we need to take responsibility for the results in our lives. I do think, with that said, I do think the system fails us when it comes to financial education. And then when people do start to invest in their financial education, they start to hear these types of blanket statements, these one-size-fits-all strategies where it's either buy term and invest the difference or nothing else. And you will not need life insurance when you reach retirement because you're going to be self-insured. And yet that just is not working for a lot of people. And it's amazing to me how many people seek out permanent life insurance because it finally starts to click. Like, hey, you know, maybe my investments didn't do as much. And I'm going to get to that in a second. The investment, like the whole self-insured bull crap. We'll get to that in a second. But like a lot of people end up wanting to get some type of permanent life insurance because they want to make sure taxes are covered, memorial expenses, and maybe pass on a little bit of money to their favorite charity or their kids or whatever. And it's so frustrating because if they had been provided the right information up front, like way early on. Because when you're 60, 70, 80 years old, I'm not going to say it's too late, but it's certainly not as efficient. If you were to get for example, a whole life policy when you were 20, 30 years old, like you don't even have to put a ton of money into it for that thing to really compound for you over 30, 40, 50 years. And not to mention too, you can pay off a whole life policy, just like you pay off the mortgage on your house and you no longer have a mortgage payment. You can do the same exact thing with a whole life policy. So maybe when you're 30 years old, 20, 30 years old, whatever, all right, you put a few hundred bucks a month into a whole life policy for 10 or 20 years, maybe till you're 65. And then it's paid off. You never make another premium payment ever again. And that thing is going to be there with you until the day you die. Not to mention all the other benefit. Like right now, we're just talking about the death benefit, like the life insurance component of it. We're not even talking about the supplemental retirement income, the long-term care protection, right? Serving as an emergency fund throughout your life, like all the other benefits that you get. We're just talking about the death benefit at the moment. But if I could set up a policy at 30 years old, pay into it for 10 to 20 years, never make another premium payment, it's going to continue to grow for the rest of my life. It's so much more efficient. You're much more likely to get approved. You're going to get so much more death benefit. Why on earth could we not combine that with something like buy term and invest the difference? Maybe we take a portion of that investment difference, because you're not putting all of that invest the difference into stocks. Some of it's going into bonds, right? What if we took a portion of that bond portfolio, redirected it to a whole life policy, we pay into it for 10 to 20 years, because whole life is a phenomenal bond alternative. All right, I've talked about this extensively on why that is on my channel. Make sure you guys check that out. But we can actually do both. And then it's paid off by the time you retire, and it's going to be there. Like, why are people waiting until 60, 70 years old to get permanent life insurance? It's because of crap like this, these stupid myths, these stupid blanket statements and one-size-fits-all strategies. And people are convinced that that's the case. And then at 60, 70 years old, they realize, holy crap, I need permanent life insurance, or I want permanent life insurance. And then a lot of times it's too late. So any thoughts on that? Because then I do want to talk about the self-insured part as well. I want to make sure we hit on that. But any thoughts on anything I just mentioned?
Yeah. And again, it's pushing their narrative. That's what it comes down to, right? Because what are they going to do? They're going to turn around. They're going to tell you, put your money in this mutual fund. Like that's the best thing to do. Right. And that's something we can have a whole nother conversation on, is all the fees inside of a mutual fund are insane, right? They're going to eat away at your wealth.
Some of them are insane, man.
Yeah. And it's like, you can literally go put your money in like VOO, a Vanguard S&P 500, get the same performance.
If not better.
If not better. Most likely it's better, because only 4% of mutual funds, only 4% of mutual funds actually beat out the market. So chances that your mutual fund is going to be the one that does it is very, very slim.
It's pretty low.
Right. Not to mention the fees. But if you go into these like an ETF, right, exchange traded fund, these fees are basis points, like 3 basis points.
Right.
You're not paying all these fees. So it's funny because everything else is the devil except what they sell. Right. And so
pretty much.
Yeah.
So, and it's just frustrating, man, because people are really paying the price for that, man. They realize, but the problem is they don't realize it until oftentimes it's too late to really do much about it. I'm not going to say anything, but to do much to fix the problem and to achieve what they're trying to achieve, when if they just had the right information, all the facts about how these different assets and components work together, let's set it up early. All right. They wouldn't even be in that situation. And like one of the things that in buy term and invest the difference, the buy term and invest the difference crowd likes to hype on or jump on with whole life insurance is like, oh, it gets a terrible rate of return. All right. So first off, you don't set up a whole life policy for rate of return, just like you don't set up a savings account to get the highest possible rate of return. Right. It's like, this is a savings alternative. But at the same time, if you set these things up early enough, you would be amazed at what it can turn into. When you give 4 to 5% in a tax advantaged environment, 3 to 4, maybe 5 decades to grow. Oh man, like maybe it doesn't keep up with a 12% mutual fund like Dave Ramsey likes to push. Okay. But it's still going to be pretty impressive. And like I said earlier, you don't even have to pay into it for your entire life. Right. So it just comes down to setting these things up early enough. And, here's a couple of things about the investment side of it. Is number one, there's a couple of problems here. Number one, how do you know what your investment is going to do? Like, I see a lot of, financial advisors talk about like the market averages 8 to 10% or whatever. Like, first off, that's a pretty big gap. Like that can make a pretty big difference. So like, it's really hard to make any type of realistic financial projection on that because you don't know what the market's actually going to do. How do you know we're not going to run into another lost decade like we did from 2000 to 2010? What's that going to do to the average rate of return? All right. So that's number one. But let's assume that the market does well. Here's another part of the problem is, were you able to put enough money into these investments to really move the needle? Because the average 401k between the ages of 55 and 64, right as they're approaching retirement age, is roughly around $270,000. I'm sorry, that is not enough to last 20, 30 years of retirement. All right. And it's not because the market didn't perform, because people can't put enough money into it. Right. So that's another thing to think about. And then the last thing I'll say, and I'll get back to you, Michael, I'd love to get your thoughts on this, is this concept of, so we're going to buy term and invest the difference. You're not going to need life insurance after 20 to 30 years because you're going to be self-insured. Okay. My biggest issue with self-insured thing is, like, let's assume everything was perfect. You put enough in, market performed great, whatever, is you are asking your retirement portfolio to do an awful lot of stuff for a very long time. Okay. You're talking about, I'm going to use my portfolio as an emergency fund, long-term care as well. Because I got news for you guys. 7 out of 10 people, 7 out of 10 Americans will need some type of long-term care assistance in their life. So thinking that, that kind of stuff is not going to happen to me is ridiculous. And long-term care, it varies from state to state, but we're talking about tens of thousands, sometimes hundreds of thousands of dollars per year in assistance. Okay. So it's going to provide your retirement income. It's going to protect you from long-term care expenses. It's going to cover emergencies. It's going to be your life insurance, right? It's going to be what you pass on to your loved ones. Like, you're trying to get this retirement portfolio to do a lot of stuff that it actually wasn't meant to do. Not to mention that a lot of the times, like, especially if money is locked up in these tax qualified plans, it's a very inefficient way to generate income right from the start. And now we're putting this elephant of a task on top of it as well. When, hey, I got news for you. A whole life policy has that long-term care protection, has the death benefit, can provide the supplemental retirement income, doesn't impact your investments really whatsoever. You're just transferring a portion of the bond part of it, and then you pay into it for 10 to 20 years if you want. Like, so that this idea of self-insured, like, I think they're so focused on the ending like the balance, like the big number that is supposed to be at the end, and that $1 million is going to cover everything. I got news for you. You're rolling the dice, man, with that kind of stuff. Like, and you're talking about a lot of financial management to make that work. So a lot of problems, in my opinion, with the concept of self-insured. What do you think?
Yeah, 100%. And Matt, my favorite casino is the stock market.
Amen.
That's the reality, right?
Sometimes mine's crypto. I like to go back and forth, but yeah, stock market's good too.
I love the stock market. So I love holding stocks. I love buying, selling. I love options trading.
It's fun.
Like I said, my favorite casino is the stock market. But that's what you got to understand, right? It's not that the stock market's bad or anything like that either. But how are you allocating your risk, right? Are you, true diversification is not all in one asset. Right. Oh, I own Apple, but I also own Microsoft, so I'm diversified. No, you're not, right? Because you're in the same asset class. So to have a different asset class is how you have true diversification, having life insurance, having real estate, having gold or crypto
Yes.
or commodities, right? That's how you truly diversify and manage your risk. But I want to hit on something you mentioned, like the long-term care, Matt. And this is huge, right? Because the Rockefellers understood this, right? The idea behind the Rockefeller strategy, utilizing whole life insurance, was not just the fact that they wanted to spend the cash value, right? But they wanted the death benefit to replenish the wealth.
Right.
And so for a couple, let's say you have a couple and the first spouse ends up needing long-term care, ends up at a nursing home, $12,000 a month. I know in California, it's $12,000 a month to be in one of these facilities and get care.
Crazy.
And if you only have your retirement account but no additional benefits, you're going to spend down that retirement account. And then when that first spouse dies, the second spouse is left with what?
Right. Yep.
Right. In your whole
that
life,
happens all the time, guys. Don't tell me that doesn't happen.
In your whole life insurance, you can spend that asset down and you're still going to have a large death benefit that's going to replenish the wealth for your spouse so that they can continue on after they're gone, after you're gone, right? So again, it's just understanding what is it that I want to accomplish, right? Do I want to protect against that? And if you're a married couple, I mean, I know there's people that go through divorces and maybe hate their spouses, but for the most part, you want to take care of them, right?
I would hope so.
I would hope so. Yeah. I think the couples that make it that long, they for sure do. I would think, right? So, but that's what whole life can do for you. It can be a portion of your portfolio that's safe, a portion that's going to grow on an automatic basis. By the way, it can be a volatility buffer. So if you're in retirement and all of a sudden there's a market crash, well, you don't want to pull while your stocks are on sale, right? So, hey, you know what? Let me take from my cash value that I know is growing every year on a guaranteed basis. Let my stocks recover, and then I'll wait a couple of years to sell the stocks at my price before I continue taking income from that location. Right?
Michael, I would be very curious to hear the response from a buy term and invest the difference agent on their, like, what their thoughts are about a volatility buffer. What's the volatility buffer in their strategy? Maybe they have one. I don't know. I don't think so. I've never heard of it, but I'd be curious to hear what that would be. Or if you follow, like, you know, what Dave Ramsey says, where you're going to average 12% every year, so you can withdraw 8. Like we don't need a volatility buffer. It's going up 12% every single year, right? Except the reality is that that's not the case. So I'd be curious to hear what they say, what their response is to the idea of having a volatility buffer, because that can literally save your retirement portfolio.
100%.
Because if you start selling assets when the market's down 10, 20%, you're significantly decreasing the longevity of that retirement portfolio. 100%. If you do not have something else to tap into until the market recovers, you're screwed.
Yeah.
It's very risky.
And I'll add this, right? Because inflation risk is a risk in retirement. But when you have a strong foundation of money that you know is going to be there, this is also a case that you can make for an annuity with a lifetime income. When you know a portion of that income is going to be there every month and you're worried about growing your money, you can take a small portion of your money and be a lot more aggressive with it, knowing that you have a safety net or a backstop. Right. So you can actually take more chances having that behind you.
Right. No, that's a really good point. Again, it'd be another thing I'd like to hear a response to from them is on that side is, like, what are their thoughts on annuities? Because it's the primary focus is on all the money that the market is going to make, and then that's going to be your retirement income. But here's what never made sense to me about that is, if the idea of building up this retirement portfolio is to generate income, when it's time to generate income, why would we not want to generate it in the most efficient way possible, in the best way possible? Because, you know, investments in the market, like, they're good wealth accumulation vehicles. They kind of suck when it comes to wealth distribution, which is an entire new game. and you need different assets in that very different phase. You can literally create the same amount of income. Like if you're going to stick to the 4% rule, withdrawal rate, okay? Let's say you got $1 million, that's going to be $40,000. Okay, well, you could take a portion of that $1 million portfolio, transfer it to an annuity, generate the same amount of income with less money, and still have money in the market if you wanted to. And it's guaranteed for life. Now, correct me if I'm wrong, Michael, but the last time I checked, there isn't a 401k, an IRA, or stock market investment that guarantees income until I pass away.
Yep. Nope.
I might be wrong on that, but I'm pretty sure that's the case.
I've dealt with many.
Why wouldn't I take advantage of that asset class, that vehicle?
And I've dealt with many clients where we've looked at annuities for them, and maybe they're a few years out from actually retiring, maybe 4 or 5 years, 7 years, and we've done the math on those, and we ran the annuities, the guaranteed income on a guaranteed basis versus what they would have to accomplish in the stock market to achieve the same thing over that same time period.
Right.
And the annuity wins every time.
Right.
Every single time. And it's not even risk.
It's probably not even close.
It's not even close.
Like the annuity smokes it.
Yeah.
When it comes to income generation.
Yeah. So, yeah, it's
because and I think that we need to make that distinction really quick too, is that this is an income vehicle, not an accumulation vehicle. So again, we have to get away from just being so fixated on rate of return, because rate of return shouldn't be the primary factor. We need to consider it in different phases of our life, in different investments maybe, but it shouldn't. Annuity is not meant to get a massive rate of return. It's meant to distribute income in a very efficient way. So instead of being imprisoned by this 4% withdrawal rate, what if I could take a portion of my portfolio, not even all of it, and live by an 8% rule, 7 to 8%. And I still have money in the market. So for those of you that are obsessed with watching the stock market every day, you could keep money in it. I'm
a fan of having both. So like I said,
both, man.
I got my whole life.
Yeah, I got my whole life.
I got my safe money, and I love, like I said, casino. Stock market's my favorite casino.
I'll tell you what, Michael, you can enjoy the casino more when you're not relying on it for your livelihood.
Yep.
Right. Like. It was a great point you made earlier about having a more holistic approach to personal finance, where you have your safe money. Then you have, you could play in the stock market a little bit if you want. Maybe you got some crypto, Bitcoin. Like I have my whole life policies. I do real estate lending. I love my Bitcoin. I love my high income ETFs. Like I have all these different things, and I can play in that Wall Street casino and get that excitement, that rush of watching, 20, 30% fluctuation, whatever. But it's because it literally doesn't impact me really whatsoever. Like maybe I'll win big, but if I lose, I don't really care. I don't care what the stock market does every day. I could not care less. I look at it every day, but I don't give a crap. It has no impact on my standard of living whatsoever. And people are just like so reliant on one or two specific financial vehicles. They put all their eggs in one basket because they believe in this one specific narrative, and they haven't taken a step back to ask themselves, like, hey, is this the best thing for me to be doing? Maybe there's some other strategies, assets, financial vehicles I can use to create a much better financial situation for myself. Maybe there's different tools I can use to get a more optimal outcome. We're not taught to ask those questions. And so, you get like people like, unfortunately, you were talking about earlier, they're 60, 65 years old trying to get permanent life insurance. It's that. It sucks. There's a much better way to do it, guys. So. Yep.
Just gotta plan ahead, right? Like you said, you get to enjoy things more when you don't rely on it. So.
Yes, 100%.
There's a myth I want to, before you get to the next myth, there's a myth I want to just take care of right now. And that's the idea that whole life insurance and term insurance are two different products.
So the myth is that there are two different products.
Yep.
So this is an interesting one because they seem like two different products to me. So I'm curious.
So when you break down life insurance, the reality is all life insurance works the same.
Okay.
So again, what are you doing when you buy life insurance? You're transferring risk, right?
Mm-hmm.
So if you're transferring risk, the insurance company has actuaries that calculate this is what the risk is, right? And we know as we age, as we get closer to our mortality date, that risk is considerably higher, right? So that's why the prices for a 20-year-old are completely different than prices for a 70-year-old.
Right.
70-year-olds on the back end of that risk, right? You have an incline in risk. And so what you're doing with your life insurance is you're levelizing that risk. So anytime you levelize the risk when you're going up on an incline, that means you're flattening out that curve, right? So in order to flatten out that curve, it means on the front end of your policy, you're technically overpaying.
Right.
Right. Because the cost that year to cover your risk is not what you're paying, right? You're paying more than that because you're leveling off the whole lifetime of the policy.
Right.
Now on the back end, the risk is above what you're paying, right? So you're underpaying on the back end of that policy.
Right.
Now, the only difference between whole life and term in this case is whole life is going to cover that for your whole life or mature at 100, right? Whereas term might only cover it for 10, 20, or 30 years. But make no mistake about it, even in the term policy, they're levelizing the risk, meaning you are overpaying on the front end, underpaying on the back end. And if you need any proof, just go run quotes for a 30-year term, a 20-year term, and a 10-year term, and you'll see the shorter you levelize that risk, the cheaper those costs are, right? The 30 year is going to be the most expensive. The 20 year is going to be the one in the middle, and the 10-year. And if you even go a step further, if you look at the actual cost, which you can do, run a quote for an annual renewable term, and you'll actually find the actual cost for your specific age that particular year, which will be even less than the 10-year term, because now you're actually buying the curve, not levelizing it, right?
Not leveling.
And so when you start to understand that the functionality of all life insurance works the same, you're levelizing a risk or you're overpaying on the front end, underpaying on the back end. So the only difference between whole life and term is the guarantee that whole life's going to actually be there. That's literally the only difference from a functionality standpoint between term and whole life.
When it comes to the death benefit.
Right. And when it comes to that overpayment, the definition technically, and this is another myth we can talk about because this is one that these people use, is you're going to get that overpayment as a return of premium as a dividend. So you're going to get that in the form of cash value. Well, this is actually what started the whole thing, Matt. This person called it trash value. But if the term works the same way and you're overpaying, but you're not getting that back in the form of cash value, the insurance company is keeping that. Right. How is it better to not get that in return and have the insurance company keep that?
Right.
How does that make sense that it would be better for you not to get that back?
Right.
And
so
not have cash value.
It seems this is, I think, is the difference between short-term and long-term thinking as well. Because they're so focused on what is it costing me at this particular moment, right? So because it's so cheaper, I'm willing to give up that long-term return of premium that I get with the whole life. The problem with that is these aren't short-term decisions. Like, we need to be thinking long-term about these things. And yeah, it makes sense to me. Long-term, I'd like to get my premiums back plus more. And that's kind of what happens with whole life insurance, right? Yep. Eventually your cash value exceeds what you've put into the policy.
Yep. And that's
not to mention the death benefit you get, but just talking about the functionality of that policy. Yeah, I'd like to get that back. Even if I have to pay more up front, I'm okay with that. Because in the long run, it's coming back to me.
Yeah, and even that, right? The dividends are a return of premium. Well, first of all, the cash value, you're going to get the equity whether you have dividends or not, right? But the dividends are extra on top of the guaranteed interest rate, right? And so that might be an extra 1.5–2% of the total growth. But to say that they're just return of premium is a little misleading, and I would call it a myth, because yes, it's technically a return of premium, but what did it do? It went into the general fund and it grew interest. Mm-hmm. So it's the return of premium plus interest, because if it was simply return of premium, you could never exceed your initial death benefit or your initial amount.
And just, you
would never have more cash value than what you put in, but within a few years, you have more cash value than what you put in.
Right. See, the return of premium, it's a tax classification. That's really what it is. Because, like you said, it's not just them giving back the premium that they overcharged me, because then my policy wouldn't, like you said, wouldn't exceed what I put into it. But money goes into the general fund, earns whatever interest, and because we are part owners in the company, we participate in the profitability of the company. So after all expenses are taken out, that dividend gets sent to the policyholders in addition to what they overcharged us for that particular year, right? So it's wrapped up in one, but the tax classification is really powerful because that's what allows it to grow tax deferred. Then we can access it tax-free later, if we're strategic about it. But the return of premium is just a really massive tax advantage, is really what it is.
100%.
So, but again, you don't know that if you don't, if you just blindly follow these, these crazy myths and statements that some people make. And I tell people all the time too, Michael, don't take what I'm saying at face value, or Michael. Like, this is just to put some things, like, to bring it to your awareness so that you go out there, do your own research and figure out what's best for you, as opposed to blindly following these different strategies. And then by the time you're 60, 65 years old, holy smokes, it didn't work out for me, it's too late. Like, I don't want that to happen to you. And the only way that's not going to happen to you is if you do your own research on this stuff. That's it. So I think we covered a lot there. Was there one other myth that you wanted to cover? Because I'm going through what I got here on my list, but I asked ChatGPT to come up with some more and didn't really find any juicy ones. So did you have any more that you wanted to cover?
I think those are the main ones, because that's the ones that
we covered a lot.
Those are the
Maybe
main ones.
Do a follow up later.
Yeah. This group of agents, that's what they scream from the top of their lungs, what we covered, right? So
these are the primary ones.
Yeah. See what you did there.
Awesome. Yeah, good stuff. Yeah, right.
The primary ones.
Yep. Primerica ones. All right. Well, we'll go ahead and wrap up with that. As always, man, really enjoy the conversation. I think this stuff's really important so that fewer people run into the unfortunate scenario of reaching retirement, realize that maybe they could have done something a little bit different and that they were misled a little bit or whatever. I just don't want to see that happening to people. And these are the types of things that I hope puts it on the radar, at least gets people asking questions. So I appreciate your time. It's been awesome, guys. I will link to Michael's resources down below if you want to connect with him over at IC Life. They're doing awesome stuff. And can't wait to have you on again, man. Let's make sure we get something set up and we don't go months and months without doing this, because this is definitely one of my favorite parts of the week.
Yeah, no, mine too. I look forward to these videos and hopping on with you, because I know you share that same passion to just educate people and break down these myths and lies that are out there.
That's the goal.
And help people get on the right track. So
for sure. All right, guys. Well, appreciate you watching. We'll connect with you next time. Michael, talk to you soon, brother.
Talk to you soon.
All right.